By the way, it's the exact same problem here. If you look at 10 billion AUM for Bitcoin ETFs amongst BlackRock and Fidelity and these other Bitcoin trusts, well, what does that translate to? 200,000 Bitcoin being in the hands of a small group of actors who are regulated. They have the exact same power as Circle now with Bitcoin. As more of these legacy actors come in, they'll acquire more and more of the supply. They already have a fifth of what Satoshi has. Remember the panic scenario in Team B? Team Orange keeps saying, what if Satoshi comes back and sells all of his coins? Well, you have just invited in some of the richest, most powerful multinational globalist organizations to own 200,000 of your coins.
Amid growing buzz and excitement in the cryptocurrency industry about the spot Bitcoin ETFs, there have been some dissenting voices that believe the whole exercise is antithetical to what the industry represents. In a recent video, Cardano founder Charles Hoskinson shared his concern about the latest additions to the cryptocurrency industry, especially large Wall Street players like BlackRock and Fidelity. Hoskinson titled his video, "Legacy is Eating Crypto," and in it, he makes the case that the industry is celebrating the acceptance of Bitcoin into the big boy quarters. But what is really happening is the corrupt legacy system getting a free pass into Bitcoin and crypto. About 2 weeks ago, analytics firm K33 Research reported that the 9 newborn ETFs had amassed over 200,000 Bitcoin, worth around $9.5 billion at the time. ETFs reached that historic milestone after less than a month of trading. The Bitcoin ETF approvals and the mass accumulation of Bitcoin have been great for crypto asset prices, with Bitcoin now trading at over $50,000 for the first time since late 2021. However, Charles Hoskinson cautions that the industry's fixation on price gains and complete disregard for the danger these products pose might spell doom for the entire industry in no distant future. In the course of the video, which was uploaded on YouTube a few days ago, Hoskinson also warns about asset-backed stablecoins like USDT and USDC. The Cardano founder believes both stablecoins especially, as well as other regulated assets like them, pose a significant threat to the continued development and autonomy of the cryptocurrency industry. As we bring you clips from Hoskinson's video, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks and enjoy the video.
So recently I was on several different podcasts and I made the point that algorithmic stablecoins are an essential thing that we need to, as an industry, look into, and that asset-backed stablecoins are a little problematic. So this comes from PowerPoint that's produced internally, but I wanted to share it because I really, really like this data from Coinmetrics and Illumium. So anyway, stables represent about 10% by value of the crypto market cap, of which USDT and USDC are the overwhelming majority of those things. Okay, but they dominate the on-chain transaction volume, about 70% of all transaction volume. So from a crypto perspective, ETH and Bitcoin take a backseat to USDC and USDT. These are, by volume, the value transfer mechanisms of our industry. They represent the huge majority of on-chain traffic and value transfer in our industry. Now, there's something about these two guys, USDT and USDC. They are asset-backed. Very important term, asset-backed, which means that there are two properties you can't get away from. One property is that there's a central issuer. There is a company who is regulated in a jurisdiction, subject to that jurisdiction's rules and regulations, and whatever that jurisdiction wants to put upon that company, permissive or otherwise, they are subject to it and cannot get out of it. They're a business like a bank or anything else responding to that regulation. And I'm not diminishing or saying they're bad actors and that they're evil people or something. I'm just saying that they exist within a jurisdiction. They're subject to regulation. Crypto does not. Crypto is a global asset. The people who hold it are subject to their local regulations. So if you're in Estonia, you're subject to that. If you are in South America and Argentina, you're subject to whatever it is there. And of course, the United States, you're subject to that. And if you do business with a U.S. person, then suddenly you're now under U.S. jurisdiction. But Bitcoin as a protocol doesn't wake up in the morning and say, I follow the US law. A stablecoin that is asset-backed does. There's no way to get around that. And the top two basically have to follow, for the most part, what the US government says. Even if they're running away from it a little bit, like Tether, they still, at the end of the day, they can't push too far in one direction. So that's the first set of problems with asset-backed stablecoins. The second set is they can't go fractional. And that's a good thing. But with a hard fork, let's say there's Bitcoin splitting and there's Bitcoin A or Bitcoin B, or more pertinent to this example, Ethereum splitting, Ethereum A, Ethereum B. You can't have a situation where the stablecoin issuer says, you know what? I'm going to let my stablecoin be on both sides and we'll just let it ride. Why? Because doubling the supply means that they're only backed by 50 cents to the dollar. They have to pick a winner. They either pick A or they pick B. A or B, but not both. They can't pick both by design. If 70% of all your transactions, all your value transfer is occurring at that stablecoin level, and your entire DeFi economy relies on that, you can't be the chain that suddenly loses USDC or Tether. You have to be the other chain. So what if they split and one says we're going to put KYC into the whole system and the stablecoins support that split, and the other side, well, they just lost their stablecoin. Means they lost all their liquidity. They lost all their DeFi backbone. What do? That property forces them to pick a winner. You have now implicitly given to the stablecoin issuer, the asset-backed stablecoin issuer, that power. A small group of people you've never met, you have no relationship with, you didn't elect them, they have nothing to do with your underlying asset. They have that power, that authority now.
According to Hoskinson, algorithmic stablecoins are a better option as they are not subjected to the same limiting factors as asset-backed stablecoins. Hoskinson explains that algorithmic stablecoins are backed by other crypto assets, and the algorithms that custody the whole process are on-chain, not necessarily under the sole control of a centralized entity or regulator. He claps back against people who use the example of the Terra Luna collapse in the argument against algorithmic stablecoin, adding that one example does not automatically condemn all algorithmic stablecoins. In his video, Hoskinson also talks about the celebration of spot Bitcoin ETFs and the complete disregard for the danger such centralized custody poses for the leading cryptocurrency. In stark contrast to many other cryptocurrency investors, Hoskinson does not seem particularly excited about the number go-up arguments pro-ETF Bitcoiners have put forward. Here are more clips from the video.
By the way, it's the exact same problem here. If you look at 10 billion AUM for Bitcoin ETFs amongst BlackRock and Fidelity and these other Bitcoin trusts, well, what does that translate to? 200,000 Bitcoin being in the hands of a small group of actors who are regulated. They have the exact same power as Circle now with Bitcoin. And you have all the Team Orange running around saying, well, no, they don't. The miners are in control. Okay, well, let's go do the experiment. You fork and you have Bitcoin chain A and Bitcoin chain B. And the ETFs say, you know, we support chain B. So what do? They take whatever assets they have that have just been replicated in chain A and they sell all of it. What does that do to the price of chain A? It goes into free fall. And you know what happens is the miners, they say, well, same hash power, but if I mine A, I get 25, 50, 60% less than if I mine B. I'm just going to move over to B. Hash power falls. The dominant chain is chain B. As more of these legacy actors come in, they'll acquire more and more of the supply. They already have a fifth of what Satoshi has. Remember the panic scenario in Team B? Team Orange keeps saying, well, what if Satoshi comes back and sells all of his coins? Well, you have just invited in some of the richest, most powerful multinational globalist organizations to own 200,000 of your coins. And you've done it. Happy, 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 joy, joy. Every day. You're fired up about it. Why? Because number go up. Then you look at the centralized exchanges. They get to decide list A, list B. You see the trend here? So hang on a second here. How many big exchanges do we have in crypto? The top 3 control the vast majority of our transactions and trade by dollar value. Small group of ETF holders, small group of centralized exchanges, 2 big asset-backed stablecoins, which constitute 70% of the value transfers. Sum that up, 10 legacy regulated institutions control the vast majority of your value flow and also get to decide the future of all of these projects. Why? Because if you go in a different direction, they won't list you, they won't give you a stable coin, and they'll dump your coin if you go in a different direction for a project that you love. You tell me, is crypto eating legacy or is legacy eating crypto? This is something cryptocurrency Reddit can't understand, because the only metric that matters is number go up, anything mentioning my name bad, and Cardano is a scam. Lo and behold, we're one of the few ecosystems that managed to stay a little bit out of the fray because we weren't a VC Ponzonomic coin. We just organically grew. And for the most part, most of Wall Street has ignored us. For the most part, most of that legacy infrastructure hasn't paid too much attention, and we've had organic TVL and organic growth. Now, the community is starting to invite the vampires in. It's not my job to say it's a good thing or a bad thing. It's my job to go ahead and say, I have concerns, and to let people know that when these people come in, they gain a lot of power and influence. They get to decide your level of transactional privacy, your custodial standards. What is a wallet? What are your listing criteria and the governance therein? What chains are legitimate? What chains are not? What consensus is legitimate? What consensus is not? Who gets liquidity and who doesn't get liquidity? Which jurisdictions? And dozens of other things. They get to decide all of that. And if they decide that you're not worthy, like Monero getting delisted with most of the modern exchanges, it's shit out of luck. Is that the revolution we signed up for? To have 10 companies come in and completely take over cryptocurrencies and basically run them and control them? I didn't sign up for that. I don't think a lot of people did. But if your only criteria is number go up, that's what you get.
Hoskinson concluded his video with a warning: you should be able to participate in markets without fear of censorship and exclusion. This is the bedrock of the revolution that is cryptocurrencies, and none of this means anything if we hand all those things to legacy actors. Please share your thoughts on Charles Hoskinson's video and his dire warning for cryptocurrency investors. Meanwhile, Hoskinson is not the only one with a warning about Bitcoin ETFs. Popular Bitcoin advocate Max Keiser has also expressed concern about Bitcoin-based exchange-traded products. On Thursday, Keiser quoted a tweet about New York Attorney General Letitia James's recent remarks about seizing former U.S. President Donald Trump's assets if he fails to pay the $355 million penalty imposed in the state's civil fraud case against him. Keiser's response to the statement reads, "If they can do this to Trump, they can certainly seize Bitcoin held in Bitcoin ETFs and commandeer U.S. Bitcoin miners, self-custody, or lose it." In another post he made the previous day, Keiser shared a bullish price prediction for the leading crypto asset and predicted an impending market crash for other financial assets. His post reads, 1987-style crash coming. Bitcoin, the ultimate safe haven, will soar past $500,000. Gold will continue getting demonetized by Bitcoin. Bitcoin ETFs and domestic Bitcoin miners will get seized by the US government. Hoskinson's and Keiser's concerns about Bitcoin seizure are not misplaced. The US government, as well as its counterparts around the world, regularly confiscate Bitcoin held on centralized cryptocurrency exchanges. The US government in particular is a top confiscator. As of last March, it held over 205,000 Bitcoin, worth $5.6 billion at the time, and a little over $10 billion at today's prices. However, despite the warnings about these ETFs, many Bitcoin and cryptocurrency investors are still quite ecstatic about them, especially due to their impact on prices. Please share your thoughts on Hoskinson's and Keiser's warnings. Do you think we should be more cautious of the big traditional finance firms, or appreciate how they've opened up crypto to thousands of new investors? Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.